Greetings class, and this is the video for the Excel project, and I want to just kind of give you an overview of it and give you some information that you'll need to complete it. In this video, I'm going to go through the worksheets and show you what they are and also explain how they're supposed to be completed. So the first worksheet here goes back to manufacturing overhead, and when we were looking at applied overhead versus actual overhead in the early chapters of the book. So when you're looking at this, basically you're going to go to these yellow cells and you're going to reference the numbers through formulas or calculate the numbers through formulas to show the amount that should be in here. So instead of typing in a number, you want to refer to the cell where that number comes from in this yellow cell here, or do a calculation in this cell using these other numbers up here. So this is the actual manufacturing overhead applied, and then you're comparing it to whether it's over applied or under applied. And then you complete the cost of goods manufactured and the cost of goods sold sections. And essentially that's the worksheet 1. Then with worksheet 2, you're going to go back into process costing where we looked at equivalent units. And in this worksheet, once it loads, you're going to see a very similar format or template like we did with the last one. You'll get this warning every time that you need to use formulas, not type in numbers when you actually answer these. So with the process costing, you're going to have to fill out the units transferred, ending work in process, equivalent units of production. Then you're going to do the cost per equivalent unit, and then you'll have the costs of ending work in process inventory, and then do a cost reconciliation, like what we did in the chapter. With the third item here, it's going to refer to cost volume profit analysis. And really with this, it's going to be very similar to what we did in chapters 5 and 6. When you look at it, we're going to see the actual contribution margin calculation, calculating a break-even point, and degree of operating leverage. Those all should be familiar to you. In the fourth one, we're going to look at contribution format income statement. And this information, I believe, will come from chapter 5. It's also involves some of the cost volume profit analysis, but there is something else in here that I want to show you. And they mention using the high-low method to determine a cost formula for the shipping expenses. Well, I want to show you that. We didn't really go over it in the book because it's now in the appendix. However, we did do the contribution format income statement, so I think we want to do that. But here you see the high-low method. This is on page 243. It's in the appendix to chapter 5. And this explains the high-low method. Basically what you're doing is you're calculating variable cost based on the high level of activity, the cost at the high level of activity minus the cost at the low level of activity. Divide that by the high activity level minus the low activity level. So what you have is you're taking the highest level of activity that you have minus the lowest level of activity you have, and you're taking the cost for that and getting the difference or the change in cost between those. And then you're doing the same thing for the activity levels. And once you do that, you'll get a variable cost per activity or for the units. So when we look back at the worksheet that we're doing, when they're asking for the high level of activity, they want you to go back here and identify what the highest level of activity was. So you're going to look through this and find, okay, what was the highest level of activity, and you're going to put the shipping costs in for that high level of activity. Then you're going to find the low level of activity and put that in. What's the lowest level of activity that they had here? And the units also. So you're going to take the difference in those to get the actual change, and then the variable cost per unit when you actually divide that cost by the units. So in this case, you're going to go through that high-low computation to calculate variable cost. And then at this point, you're going to compute the fixed cost portion using the high level of activity, which we go back here, and it's going to be the highest level of activity based on the number of units. And when you look at that and you calculate the total cost at that high level of activity, then you're going to subtract out the variable cost element, and you'll get total fixed cost. So you're going to go, what is the total cost here at the highest level of activity? And then you're going to subtract out the variable cost to get total, or you have a variable cost element you're going to subtract out and then get the fixed cost. So if you have any questions about this, we can talk about that when you get to this worksheet if you want to in class. I'll be able to kind of sit down with you and go over this. That's the only part of this worksheet that really kind of bothered me, because we really didn't talk about it, and the high-low method is not necessarily as important as it once was. So I guess that's why they put it in the appendix, but they left it in the project. So in the fifth one, we're going to look at the income statement, and we're going to look at how we compare a contribution approach to an absorption approach. So in this case, we're looking at variable cost versus absorption costing. So what we're going to do then is actually compute the unit price for one fireplace using the variable costing method, prepare a contribution margin income statement, and then flip that over and say, okay, what happens if they use the absorption method? And we have to change some assumptions for that. And then we're going to calculate the cost of goods sold using the absorption method, the gross margin, and then the net operating income. So that's really the fifth worksheet. In the sixth worksheet, we're going to do a cost allocation, and this is out of chapter 7, but this is really basically the kind of thing we were talking about in class. And the video that I've put up in accounting resources will help you with this. But again, what you're doing is you're looking at these activity cost pools, and you're going to complete a first stage allocation using the activity cost pools. The activity cost pools are going to refer back to these items here: customer orders, product development, customer relations, and other. And you're going to do the cost allocation for the product department or production department based on the total cost that you have here, and identify how that activity allocates out the cost. So you have this $400,000 cost in indirect factory wages. You're going to allocate that to these different cost pools using these calculations here. These are going to be activity levels or allocation percentages for each of the three departments. So you'll do that. You'll apply those percentages to actually calculate the amount of cost that goes into each of the activity pools, and then you'll total that. In the seventh one, we're going to do a budget. We're going to do a cash budget. And this is very similar to what we were doing in chapter 8. So this should be familiar to you. Once you've, if you have any questions about doing a cash budget, you can look back at that video and also the Foundational 15. That will help you. But again, with this one, we're going to it looks like The schedule is here, but the budget data is here. So we're going to go to the schedule, and you're going to calculate the cash budget that you need using that information. What are the expected cash collections? What are the expected payments that you're going to make? And so what are the total cash payments you'll have? And then you'll basically just bring that information forward and say, okay, here's a cash balance on March 1st, less these, or adding in these collections, subtracting out the payments, and so on. And then any other financing that you're going to have to do to cover that, or any repayments you're going to make, or any interest that you're paying on it. So that's the budget one from chapter 8. With the 8th one, we're looking at chapter 9 stuff. We're doing a performance report, and in this case, we're going to calculate the flexible budget versus the planning budget versus the actual activity. Which, if we're looking at that, we should remember then that worksheet that we did, where we actually looked at, okay, here's the planning budget, but we need to adjust it based on activity. So then we need to actually identify, okay, what is the planning budget, what is the flexible budget, and what is the actual results? And then we're going to plug in those variances. We're going to identify what they are. With number 9, this is going to be a basic variance calculation. This is out of chapter 10, and with these variance calculations, there will be a video up shortly for chapter 10 as well. But when we're looking at variance calculations, what that means is we're going to actually calculate. There was a question on the test about this. What is the quantity variance? Well, you're going to calculate the quantity variance here. So you're going to have a standard cost variance for direct materials, a materials quantity variance, and a price variance. And it's going to be based on those formulas where you take, if you're looking at the quantity variance, you're basing it on the actual price times the standard quantity minus actual quantity to identify the quantity variance, and materials will price variance will be similar to that. For direct labor, you're going to look at the hours variance and so on, and then variable manufacturing overhead, you'll look at that as well. Like I said, I'll have a video specifically for chapter 10 very soon. You'll be able to see that. Then the last one we have not covered yet, but we will. This is going to be make or buy decisions, and I think this is a very important application of managerial accounting. When we're looking at decision making for management and using or applying managerial accounting, we're going to do some calculations here to tell us whether or not we should make it or whether we should buy it. So we're going to do a differential analysis actually. And what we're going to do is we're going to identify the cost of making the product versus the cost of buying it. So then we're going to make a decision. We're going to have a total cost here. And by the way, making a product will include manufacturing overhead, traceable and common. And then what happens if that unit, this is a per unit cost here, but what happens if we're operating it at 12,000 units? What will that do to our calculation, or will it change it much? So then you're going to look at what you should do. You should say, okay, are we going to buy or are we going to make? So those are the 10 worksheets in the Excel project. Again, this is going to be a matter of plugging in formulas to get the numbers that they want. If you have any questions or run into any difficulty, please let me know. And again, there will be a Chapter 10 video appearing soon, along with a Chapter 12 video for differential analysis that we'll be doing as well. Anyway, that's the video I wanted to give you, and I'll put this video with the Excel project so you'll be able to look at it. and I'm looking forward to seeing these projects as you complete them. Have a great day.